We are taught from day one that the equation for success is simple. Wake up before the sun, put your head down, and grind. You trade 40, sometimes 50 hours a week, pouring your physical energy and mental bandwidth into a job for decades, waiting for the eventual payoff. But look around. The people sweating the most, logging the longest hours, on their feet, are rarely the ones building actual wealth. Meanwhile, another group of people is experiencing something completely different. Their net worth grows while they are in deep sleep, detached from their physical exertion. Realizing that raw effort doesn't dictate your net worth is the first step to seeing how the actual economy operates. There is a secondary financial ecosystem running quietly in the background of our daily lives. Think of it as an invisible money machine. It operates relentlessly, sorting the global population into two distinct columns based on one simple metric: whether or not you know how its gears turn. To get out of the cycle of living paycheck to paycheck, you have to stop focusing on your hourly wage and start examining the architecture of the system itself. The traditional path relies on a straightforward transaction. You rent out your skills and your presence to an employer, and they give you cash in return. But this transaction hits a hard mathematical ceiling. Because you only have 24 hours in a day, your earning potential is capped. You are bound by linear time. And the moment you sleep, take a sick day, or retire, the cash flow halts immediately. This structure guarantees a lifetime of continuous labor. The engine only runs if you are physically there to turn the crank. Now, zoom out and look at the wealth builders' path. They utilize the global financial market, an unfeeling, autonomous mechanism running on its own logic. Their primary tool is equity. Equity simply means holding ownership in productive assets, rather than buying goods that lose value the moment you take them home. Instead of buying a brand new car that immediately depreciates, they acquire fractional shares of the companies manufacturing those cars, businesses that generate consistent cash flow. Because these assets are productive, they possess their own internal momentum. They generate dividends and increase in value without asking for your schedule. While you sleep in one time zone, your capital is active in another. It trades on exchanges, funds global logistics, and compounds returns, immune to human fatigue. The function of this system is to transfer the heavy lifting. The burden of labor shifts off your shoulders and onto your capital. This graph illustrates exactly how this plays out over a 10-year window. Both the wage earner and the equity owner start at the same origin point here on the left. Watch the wage line. Even with the occasional raise, it stays relatively flat. Meanwhile, inflation constantly chips away at the bottom, shrinking your actual purchasing power year after year. Now look at the asset line. Without a single extra hour of physical labor from the investor, the growth compounds, curving sharply upward and breaking past the limits of a standard salary. This mathematical divergence is the reason the wealthy keep accumulating capital while they sleep. Their money is reproducing without them. Bringing this back to your own bank account, every dollar that passes through your hands represents a choice about which of these two paths you will take. The gap between the classes is driven entirely by the mechanism of income, wages versus equity, not by who clocks the most overtime. Stepping into this system requires a mental reset. You have to unlearn the lessons instilled by decades of schooling, which trained you to seek out a steady check in exchange for your time. As long as you remain strictly a wage earner, you are participating in a system where the math guarantees you will always lag behind the cost of living. You must treat your future paychecks as raw capital. Every dollar you save is a seed for your own wealth engine, rather than a mere tool for current consumption. Instead of letting every pay raise evaporate into lifestyle upgrades, you funnel your surplus capital directly into buying productive assets. Your ultimate priority becomes transitioning your identity. You move from a laborer renting out time to an owner holding equity. Once you perceive the invisible money machine, you can leverage its mechanics for your own benefit. You transition from being the fuel for the system to being the operator. Every morning, before the sun even comes up, millions of us jump into the same routine. The loud alarm clock rings, and the frantic race to trade our physical time for a paycheck begins. We grow up accepting a specific rule about how the world operates. If you want to make money, you have to be actively working. But people who actually build wealth operate on a different premise. They use an invisible money machine, a system that continues to grow their net worth even while they sleep. If you only rely on your own active labor, your financial reality is fragile. The moment you stop working, whether by choice or by necessity, the income stops with you. To see how this plays out, imagine two people sitting at adjacent desks. They earn exactly the same monthly salary. The first person takes almost every extra rupee they make and channels it into looking successful right now. A better phone, a bigger car loan, purchases that lose value the minute they're made. The second person makes a different choice. Every single month, they take a fixed amount and automatically funnel it into investments. A salary pays today's bills, which keeps you surviving. But consistently redirecting your capital is the only way to acquire the assets needed to build future freedom. The reason that second earner eventually pulls ahead is that they stop prioritizing income and start prioritizing ownership. This chart shows how capital flows into productive assets. When you own a piece of a business or a market investment, the system splits your initial cash into distinct branches. These branches then loop back on themselves, generating value independent of your physical time. Financial freedom is achieved at the exact moment the value generated by these owned assets surpasses the cost of your daily life. The mechanics driving those assets rely on a mathematical engine, compounding. This graph tracks wealth over time. The curve starts out flat because your investments are just beginning to generate returns. But soon, returns begin generating returns of their own, and the line accelerates upward. By stretching the timeline further out, we see the system's real power. This growth isn't luck. It happens specifically because capital is left alone to grow for years. Ultimately, the amount of time your money spends in the market is a more powerful force than the initial amount of cash you invested. Holding assets for decades requires surviving the daily chaos of the news cycle and the volatility of the markets. Human emotion naturally fights against this. Fear tells people to quit when markets fall, while greed pushes them toward unnecessary risks when prices rise. Successful investors learn to mute those impulses. They maintain a quiet discipline and ignore short-term fluctuations. Long-term psychological endurance, not just raw intelligence, is the prerequisite for a compounding system to succeed. While the math of compounding is ancient, a new variable is altering the landscape. Artificial intelligence is transforming how financial data is sourced and processed. This diagram shows AI's role in modern research. It filters the noise of global news and chaotic data streams into structured metrics. For an investor, this assists in risk management and investment analysis at a speed that was previously impossible. This acceleration helps those who are learning to adapt to the speed at which financial information now travels around the world. The future of wealth belongs to those who combine the discipline of compounding with these new tools for navigating a complex market. The invisible money machine exists, and it is now being supported by the analytical power of AI. But how can an ordinary person, starting with limited resources, actually use these principles today? The actionable steps to build this personalized system will be revealed in Chapter 3. Before the sun breaks the horizon, the machinery of the global economy powers on. Millions of alarms pull people from sleep, setting an unyielding rhythm for the day ahead. In cities around the world, this is the daily exchange. Workers move in lockstep, offering their most finite resource, their time, in return for a predictable, steady paycheck. Yet for the vast majority, that capital rarely stays. Almost as soon as it is earned, it is diverted toward expenses and purchases that lose value the moment they are acquired. Look at the scale of this human effort. Out of this dense sea of workers, only a fraction will manage to direct their earnings into assets with the potential to grow over time. Participating in this routine guarantees survival. But mathematically, trading hours for dollars alone cannot produce financial freedom. Mirrors a common assumption that those who manage to escape this cycle possess a hidden advantage, a secret shortcut, or a rare ability to see what the market will do next. The reality is far less certain. No one, not even the wealthiest institutions on Earth, knows exactly what the market will do tomorrow. Every successful portfolio begins in the exact same state of uncertainty as the average commuter's bank account. Even the massive halls of the financial industry operate within a continuous state of unpredictable chaos. The dividing line between those who build wealth and those who simply work for it is not raw intelligence or access to insider secrets. It is behavior. Financial independence is constructed through hundreds of quiet, calculated choices, repeated day after day. The mechanism that separates investors is a behavioral filter, the discipline to prioritize consistent long-term action over the anxiety of trying to perfectly time the market. When volatility hits, the instinctive reaction for the majority is emotional panic. They liquidate their positions, selling off assets when prices are lowest. A disciplined minority does the exact opposite. They use these moments of widespread panic to patiently accumulate assets while valuations drop. This is the quiet reality of passive growth. Successful investors remain detached, allowing time and market mechanics to do the heavy lifting. True leverage is achieved only when your money works relentlessly on its own, completely separated from the physical hours of your day. Building this kind of leverage is a mathematical process, constructed through seemingly insignificant daily decisions. This diagram outlines the core behavioral decision tree. By prioritizing financial education before investing and analyzing long-term value before spending, capital is intentionally diverted away from depreciating liabilities and channeled into a growing asset base. In the beginning, this process feels slow. The act of saving and investing yields returns that barely register on the timeline for the first several years. Eventually, the math reaches a tipping point. As the interest begins to earn its own returns, the slow accumulation accelerates into a steep exponential curve. Compare that to a standard wage. A static paycheck is permanently capped by the hours in a day, leaving a widening gap between linear labor and exponential assets. Consistency is the only reliable mathematical bridge that carries an individual away from the daily commute and toward total independence. Zooming out to the macroeconomic landscape, the traditional rules of money and labor are evolving faster than they have in previous generations. Technological forces are driving this acceleration. The integration of artificial intelligence and digital finance across global markets is changing how capital is deployed and managed. This environment introduces the risk of technological obsolescence. A static, one-time investment strategy is no longer sufficient to protect wealth in a heavily digitized economy. In this environment, a static skill set begins to act as a liability. Individuals who treat their education as a finished project often struggle to navigate shifts that favor those who treat learning as a continuous process. In a landscape of rapid disruption, the ability to continuously update your understanding of the market is the only true safeguard for long-term capital. While the focus often remains on institutions like the New York Stock Exchange, these are merely the venues where capital is exchanged. The mechanics of growth begin long before a trade is ever made. Your own financial knowledge is your most versatile asset. It is the prerequisite for identifying every other opportunity. This internal knowledge base acts as a protective shield, allowing you to recognize potential where others see risk and to avoid common errors that deplete capital. The path forward requires a shift in focus, from the immediate goal of becoming rich to the continuous process of becoming financially smarter. Wealth is the byproduct of informed behavior. One informed decision creates a shift in how capital is managed, changing the math of what is possible over the coming years. If this documentary changed the way you think about money, share it with someone who needs to hear it, and subscribe to Intel Shift for more on the future of wealth.